on?
What's up, disciplined investor?
We got Benzinga CEO Jason Raznick here with us.
The man, the myth, the legend, Tom Nash.
Peter Schiff on the Power Hour with us live today.
Interesting, different, unique, innovative companies.
Mia, you are live with us on the Power Hour. What's up?
Thank you so much for inviting me on.
Jessica Billingsley is the CEO of Akerna.
The best trade idea resource out there.
What is up, Zinger Nation? Welcome. We have a brand new show for you this evening, Options Trading with Options Mike. We have had a lot of requests from Zinger Nation to bring more options content to the YouTube channel, and I thought no better man than Options Mike himself. Mike, how are we doing?
Aaron, man, nice to be here. How are you tonight?
I'm great. It's good to see a couple green days in the market after Monday, you know.
What kind of crap is this? We were supposed to have doom and gloom. We were supposed to crash to the ground. It was going to burn. Oh, wait.
Yeah, I mean, it seems like every time we see SPY go down like 1.5%, people, you know, really freak out. And you look at like the overall chart of the SPY the last year, and it's like the smallest little smidge. And it's scary, but what do you know? Buying the dip works again. So real quick, Mike, before we get into options, you just want to give the audience a little bit background about yourself, how you got into trading.
Sure. Hey, welcome everybody. My name's Mike. You can see me on Twitter as Options Mike. Everybody knows me as that. I started trading just after the financial crash in 2008. So literally, it was just after that I started getting my first appetite for trading. And I started by doing what most people did. I started by investing. I bought the banks. I bought Citigroup. I bought Bank of America. I bought GM. I bought Ford. I bought a triple leveraged ETF called FAS, which was triple leverage for the financials. And the one I didn't buy, of course, was Starbucks, which my ex-wife at the time told me to buy. And that thing went all the way through the roof. That would have been the better trader than anything else. But once I started trading that, I started making money. And, everything worked except for GM, obviously, which went bankrupt and got delisted. Made great money during that time period. Then I naturally got attracted to options. And after a couple of years, I'm like, oh, what's this thing called leverage? And I'll never forget my first option trade. It was on Benzinga. And on this little stock called Benzinga at the time, which was running rampant, I made like $10,000 in 20 minutes. I'm like, oh my God, options are the greatest thing ever. So started trading that, and then, really kind of just got into them, made a lot of money, and then started to recognize that as the market changed, you can't trade options the same way that you would trade them every day, and gave pretty much all of it back before I finally figured out how to use them, when to use them, and when to use them appropriately, as they're just a major tool. So I've been trading now for almost 13 years and love it. And I trade full time every day, have a room. People sit with me all day long. And actually, if you look on screen, you'll be able to see some of the stuff that's in the room on the right side there. So sharing what everybody sees on a daily basis, some of that with you.
Yeah, beautiful. And it's kind of serendipitous there that your first big options trade was with Zynga. And here you are 12 years later on Benzinga.
Yeah.
So I just real quick, my kind of background in options. So I've been investing for a while, since like before I was 18, had some money, always loved Apple stocks. I've been in Apple stock for, probably 12 years, since I was like 13 years old. But my first stint with options trading is actually funny timing wise. So I downloaded Robinhood, bought my first option contract last February. So essentially like a month before the market crashed from COVID. And my background is more in media. So I went to journalism school, and so I've always been kind of following news very closely. And so follow a lot of different news accounts, international news accounts on Twitter. And at the time, so I was actually buying, my first options contract was buying a call on ticker BAM, Brookfield Asset Management.
Okay.
And it was kind of an earnings play. They had earnings coming out last February. My thought process was like, all right, it's an asset management company. The economy has just been so strong for 4 years or whatever, or for 2 years since the 2018 dip to 2020. I was like, how could they not report good earnings, right? They're an asset management company. It's the economy's been unreal.
Those are famous last words, by the way.
Well, it worked out in that trade. But then as, literally the crash was like a month later after my first options trade. And I was following all these news accounts and seeing what was going on in Europe and stuff. And Italy was shutting down. I remember specifically, it was like the last weekend in February, right? And Italy canceled all their soccer games. So the Serie A, Juventus, AC Milan, And I was always kind of like under the boat where I was like, oh, this COVID, it's going to be another thing like Zika or Ebola, where all the major news outlets talk about it for, 8 hours a day, but it doesn't really have that great of an impact. And then I saw that and I was like, wait a second, that's a little weird. That'd be like if here in the States, we canceled all the NFL games on like a Friday before the weekend. So me and a couple other buddies that were more into finance were like, let's start buying some puts on some of these like oil companies, whatever. And I turned like $800 out of my checking account into like 10 grand on these puts. Well, it was nice, but then I ended up like losing all of that because I kept everything short when the market turned around because the news kept getting worse about COVID and the markets didn't care. Lo and behold, I learned my lesson there. So at least I learned
the old saying, right? Bears make money, bulls make money, pigs
get slaughtered. Yep, I was told that a lot as I told this story to people that like, oh, I made 10 grand in 2 days, and then 2 weeks later it was all. At least I learned my lesson with house money. The way I like to, at the end of the day, like if my portfolio all time was still green, it was not fun at the time, like seeing my portfolio down $2,000.
Never is. Never is.
And then I learned my lesson, and there were, in the last year, there have been times where I've made good options trades where I've like, all right, I'm going to kind of take some of that out, invest it, sit on it, where I didn't have that big, mountaintop where my portfolio went like this and then all the way back down. It's more like this and then kind of flatten out and then maybe a little dip, or maybe I do another good options trade. But that's my background in options, and I've been kind of in love with it for the past year and a half.
Yeah, and I spent a lot of time learning about it. Once I actually started trading, I said, I need to learn what these things are, how they work. Really got down into the nitty-gritty. The Greeks, implied volatility, how to start doing some advanced options, which we're not going to go into tonight. But just, I was trying to figure this out because, if you're going to really do this and you want to use them, you need to understand how they work. And, you have rights and obligations. And I think a lot of people trade options. They have no idea what they're doing. They're like, oh, I'm just going to buy a call, not realizing that they have rights and obligations whenever they do something like this that could get them in trouble if they're not really paying attention to what's going on. And, that's something we've been trying to educate people on. And, we talk about every day, what happens when I buy this call? Well, if it closes in the money, you could be assigned. And if you're assigned, you better have the money in your account to cover it. Otherwise, you're going to hear from your broker, and it's not going to be a nice conversation.
Yeah, and myself personally, I've always just kind of been trading the contracts. I've never really like exercised any of my options trades.
Right.
Probably just because I don't have the money in my account to do so.
But if you let it close in the money or after hours, it shoots into the money on expiration day, you're going to get a call.
Yeah. I'm more, I'll either have sold that contract for a profit or the contract's expiring worthless, which unfortunately the latter has happened a few too many times for my liking. But real quick, so for maybe some newer investors, what would be the benefit to trading options on a stock versus just purchasing the shares outright? So
really simple. On a stock, a lot of stocks, we can't, as retail investors, we really can't afford to trade easily. Names like Amazon and Google, right? They're so expensive. We can't afford to buy any kind of size on it, on these names. So options are really leverage. Every contract you buy in an option gives you control over 100 shares. So you buy one contract, you're controlling 100 shares of a stock. So if you're buying a name like Amazon, right, and you're controlling 100 shares, well, think about the cost outlet here, right? You cannot possibly, most people can't afford to own 100 shares of Amazon trading around $3,500 a share. So you buy options, and now you control 100 shares, and they can move for you, and your risk is then premium paid. Right now, you said something earlier, letting your options expire worthless. I almost never let options expire worthless anymore. I use stops, whether they're mental or they're actually physically in there at the time. That I'm just not going to let an option expire worthless. If the trade is not working, I get out of the way. So, you just get out, specifically on a weekly trade. If you're trading on weekly options, which for new options traders, I do not recommend because they move too fast, too hard. But, you want to have, if it's going against you, you don't have a lot of time for that trade to recover and everything's working against you. So the advantage of options, they allow you to trade names you wouldn't trade, especially with puts, calls, and it allows you to short a name using puts instead of using stock, using margin. And if you're trying to short names like AMC these days or GME, there's probably, you cannot short them with stock because it's pretty much impossible to get shares. But it's easy to buy puts on it, so it gives you the ability to be short these names, where you can't easily do it with stock. Right.
And so when you mention weekly options, are you talking about like say buying an option contract that expires this Friday if we're talking about this week or next Friday?
This Friday, right? So if you're buying a
Okay.
weekly, it's in the week's expiration. And so if you're new to options, options have a thing called theta decay. And what happens is every day that goes forward, the option decays a little bit. So even if the stock price, let's say for a week, doesn't move, that option is going to be worth less than the start of Monday because it's decaying, and it's a curve. The closer you get to expiration, the faster it accelerates. Something most people don't know is every option that closes out of the money is going to be worth zero on expiration day. So that means that as we get closer and closer to the expiration, if you're trading weeklies that expire this Friday, right, which would be the 23rd, the data decay is very, very rapid in these names. So you have to be right. You have to have the direction, your timing right, and you can't afford to sit in these and let them try to come back because often they're just decaying faster than they can push back up.
Yeah, and I know when I gave my story about how I was lucky enough to have a lot of puts when the market crashed last year. I kind of got benefited on both sides, both that the stocks that I had were going down, and also VIX was going up. There was more uncertainty in the market, so that was driving the value of those option contracts higher.
Yeah, and that's the thing about the VIX, right? When the VIX goes up, implied volatility goes up, IV goes up, it pushes the options up. The problem that happens when the VIX comes down, it does exactly the opposite, right? It brings the options crashing down. That's why shorts with puts tend to work so well because the implied volatility is going up as the stock's going down. You kind of get this massive move down, and it drives the option prices up faster, especially when you have a move like Moderna yesterday. Moderna had a big short move yesterday after making an all-time high yesterday. It finally came in and it dropped like 50 points inside of an hour or something like that. And, when that's going on, the IV and the puts is going up, the options coming down fast. It's a great time to make money using options like that.
Yeah. And kind of on the flip side, I remember initially when GameStop went all the way up to like $350 or whatever, there were people that had puts on it, and the puts the stock ended up going down, but the puts ended up becoming worth less because the volatility had kind of ran out.
Yeah, and this is one thing everybody has to learn. And I'm doing an option session on Benzinga for Saturday on the learning session. But implied volatility, when you look at one of these names and you see IV at 500% or 600%, that is a massive red warning flag that should be sending klaxons off in your head saying, do not touch this. This is the market maker's way of gaining control back. And this is not putting down the market makers. What their job is to reduce risk, right? They're providing liquidity. The way they reduce risk is by driving the cost up and then allowing them to make money back in the backside and to sell and to work it out. They also sell stock or buy stock to hedge it off. So what's happening here is when they drive that IV up, it means they're in a very adverse reaction to what's going on. They feel they have high risk. So they make implied volatility extremely high. So you're paying up to play, right? Does that make sense? You're paying higher to play. So I think if you look at AMC, its IV is typically 100%. When they bring that up like 500 to 600%, your options costs are over 6, 10, 12 times higher than they normally are. That means on your puts, as soon as that starts to come in, because they're more worried about the call side at that time, they just start draining the IV. And as the IV is coming down, unless you're getting a rapid move down in a name like GME, it's not going to pay. So, you got to be very careful when you're playing with options on names with the implied volatility is through the roof. Kind of the same thing, Aaron, that goes on with earnings. You ever notice how earnings, they jack the IV for earnings because it's an event, right? It's a binary event. They don't know what's going to happen. So they basically double the price of the options so that, you don't get paid unless the stock price goes up a certain amount. Makes it tough.
Right. And that's maybe if you have a stock where the options are coming up, and we can talk about this maybe in a next episode or something. But if you're pretty certain that the stock is going to be going either up a lot or down a lot, you can kind of play options on both sides.
You can definitely play it on both sides. I mean, you can start off with calls if it's going up, and if you think it's going to come down, you can switch to puts, right? You can go back and forth. There's strategies where you can do a straddle, or you can take both a call and a put at the same time, and whichever one works. The idea is that it's going to more than pay up for the loss on the other side. If that makes sense.
Yep. All right. So let's see. We've got Amazon pulled up on your chart right now. I think it'd be interesting for our audience to just kind of see like what you're looking at when you look at the chart and kind of how you would strategize it. How would you play it? What would essentially be your goal for the trade? Like, do you get out if the contract is up a certain amount or down a certain amount?
Sure. So with Amazon, I have been trading Amazon a lot lately because the options are also very expensive, and it's been kind of a tough name lately. But looking at this 3-day move, it's got a nice little move here going on it. So it's on my actually radar for tomorrow. The one thing it has is the 8-day above. It's sitting here at 3,600, which could be a little bit of a beast for it to get through. One of the things I always look at on a name like Amazon is what is the average range per day. It's called the ATR. It's in Thinkorswim. You can pull it up anytime you want. And, I'm going to pull it up on my side screen here for us. But the average true range on Amazon, if I can type, all right, is averaging $68 a day. So once I know that, I now know I don't need to be at the money to make money. Does that make sense, Aaron? And I think that's the one mistake most new option traders make is they say, oh, I need to be right at the money. If a stock can move $70, I can say, I think this stock is going to break loose today. And if it gets above a key level, and that area would be roughly 3,600, maybe it can move another $50 at 3,650. So I would look up at the 3,650 strike to see if that would work on it, instead of being that close to money, and let it come to me. To your point, what I would do if I was in multiple of them, what I would do is I would start trimming on the way up. So once I got, a nice profit in these, I would start trimming them up maybe at 50% or 100% on the option, take one or two, depending on how many I had. Let's say I had 3, for example. You can do one at 100%, one at 150%, and then just put your stop in the money somewhere in the last one and see if that one can go hog wild, right? But always put a stop in place on that. The one thing I hate seeing people is they don't put a stop in place, and they turn around, they come back, and the stock decided to reverse because of whatever reason. And next thing you know, they're losing money on the trade when they were up big. Always protect your profits. Always put a stop in place. You're up 100% in the option, you should take something, and your stop should be in the money. Even if it's only 10 cents, it should be in the money.
So you said if you're up over 100%, that should be your stop on the way out?
Well, what I would do is I would take some off the table, but I would move my stop so that I couldn't lose on the trade anymore. So this way, if the stock comes crashing in for some reason, I'll get stopped out at break even on whatever I have left over. This way I don't lose money.
Got it. So if you have multiple contracts and you can kind of sell a couple, get your money back that you spent on the premium, and then let the other contracts ride.
Right.
Got it. Yeah, that was something that I probably could have employed that strategy a little bit more when I first started trading options. But it was always fun for me to see, the 100+% gains on a trade. I love seeing 500.
We all do.
It made me feel really good.
But you know what? Trading is not about blowing it out of the park. When we do this full time for a living, it's about hitting singles and doubles, and the big wins just kind of come automatically with it. And, people that just always go for the home runs, you're going to have these great hot streaks. And I used to do that. And then you're going to have these streaks where you absolutely lose and you give a lot back. So really it's determining what type of trader you want to be. For me, I like to just go out there, hit singles, doubles, and the home runs come on their own, the grand slams. They just kind of happen because you're in the right name at the right time and it's just working.
Yeah. I mean, someone once told me you can't go broke taking profits. Yep. So definitely want to be aiming for the singles, the doubles. So let's see how. Do you have any other stocks on your watch list outside of Amazon?
We had some interesting flow today. If you look up here on the right side of my screen, this is like the top flow of the day, and you can see some of this comes in here. And let's start off with SoFi. Now, I didn't trade SoFi today. Some people in the room did. But what makes SoFi, I call it SoFi, interesting here is that this thing has been kind of dead for a while. And they lit up the weekly 16 calls. And these weren't like big orders. This is what makes it so interesting. They just started coming in small little lots and small little lots. And you just started looking at it and realize it's really starting to add up. And you can see the explosive candle you got on this thing here at this point. And it's still, after hours, it's still kind of moving. It's up at 1685 now. So it's still going. And this is the type of stuff when you look at, you may not be paying attention to this name, but, for me, when it, if you're watching and you see that flow come in, once it takes out that previous day's high, that's the first symbol. Maybe I should take a look at this. Maybe it's worth giving it a shot if you like it. And then once, for me, it got above the 8-day, that was game on. You can see this just nice explosive move. And again, this was not a name I had on my radar in the slightest bit today, right? I wasn't even thinking about this name. In fact, my focus today was on the crypto names because of the big event we had going on today with Kathy and Elon and Jack. And I thought that could run. And obviously, that was a big nothing burger in my opinion. So we didn't get a lot of stuff out of that. So that was interesting today. And, another one that was really interesting today was Square. And if people were paying attention, Square here, you've had this beautiful 3-day move that's breaking the range. And right on the open, they started hitting with size the weekly 255 calls. And you can see it. I have it up here at the 260s now. And what makes it special, it wasn't just a couple hundred of them. If they hit these things with like 2,500 of them in a shot on the weeklies, that's a big bet. So what that says to me, Aaron, is that somebody's coming in here and placing a big bet and they want this to move. And if you like Square, and I did trade Square today, I actually used stock on Square today. I will tell you that when I'm unsure of the market environment, I tend to go with stock because it's easier to get in and out of, and I don't want to sit in stuff. So I go in and get in and out using stock, also off of option flow. But it gave that nice move. And at the end of the day, they started making big bets into the weekly 260 calls. So that tells to me I need to watch this tomorrow because potentially this has some more room to the upside. And you can see you look at your chart, this 260 area is resistance. And above that, this thing can really start to wake up. And I think we have earnings coming next week. So it makes sense that they're trying to pre-run this into earnings.
Got it. And do you have like a different strategy for if it's, say, tomorrow on Thursday, knowing you're only, I guess, one day outside of when the contracts would be expiring versus then if you're looking at the stock on a Tuesday?
Yeah. So if I'm trading tomorrow, I might go out to the week after. Or if you're a new options trader, I would say try to go out at least 30 days or 45 days because time is your friend, right? If I'm trading weeklies tomorrow, I'm going to have my size down. I'm going to be making sure I'm not trading huge size on it. I'm going to trade within my reason and treat it more as a lotto. So, if the trade goes against me, I have to take a total loss. It's acceptable. But typically, I usually have a stop somewhere around 50%, and that's it. Typically, I size my options to how much money I'm willing to lose. So if I'm willing to lose $500 on a trade, pick your number, whatever it is. That means you cannot be trading a $10 Tesla option, more than one if you're willing to lose $500, right? You have to be trading within your size. So for me on Square tomorrow, if I'm trading it, I'll see what the 260 calls are at. And if the 260 calls are pricey, I may go up to the 265s and go there just to bring my costs down. And, part of what we do is about risk management. While the 260s will move a lot faster, the 265s give me risk control. And that's what you're looking for.
Right. So essentially, Mike, you're saying that the shorter you are, or the closer you are to the expiration date, the riskier those trades become.
They do, because again, if they don't work, everything's going against you rapidly. Like we talked about, the options decaying. If it drops, the delta drops, and it's just hard to get back to even. What I always tell everybody about options is this: if you're trading stock, and let's say you bought Square today at $258, right? If it goes down $2 and it comes back to $258, you break even. You haven't lost a penny. If you're trading a 258 option on Square, whatever the price was, let's say it was $2.60 at the time, making it up, and you drop $1 to $1.60, and then Square gets back to 258, my guess is you're probably still down 30 or 40 cents on it because decay is set in, the delta is dropping on the weekly option. So they're not going to come back like stock does. So realize that you have to manage your risk.
Yeah, and in that scenario, if you have the 258 call and it drops and then comes back to 258, you would need a bigger move on the upside to make up that 40% or the 40-cent loss on the contract that you already saw.
That's exactly it. Or you have to buy more. And I'm not a fan of adding to a losing trade. A lot of people like to do that. For me, if a trade's not going well, I have a place where I'm just going to say, I'm done. That's it. It lost. It was a bad trade. It happens. Adding for a losing trade, I'll do it once in a while, but only if I have true conviction, Aaron, right?
Right.
If I made a mistake, I made a mistake. I don't want to compound that error.
So real quick for maybe some traders that are just now, getting into options, what makes a stock better for trading options versus stock that's not great for trading options?
So number one thing is liquidity. So one of the things I always look at in a stock is, one, how many shares does it trade a day? So for example, a name like Ulta, I almost never trade with stock, period. And even with options, because Ulta, if you look down here, it does under 1 million shares a day. So for me, I prefer to trade names that have at least 1 million shares a day traded in volume because there's something there. You can get in and out of it. The next thing you do is you look at the options chain. A name like Ulta, you may find that the option strikes may only have 5, 10, 15 option contracts traded today in each strike. To me, that's a red flag. That means there's no liquidity in the strike, and that if you get in trouble getting out of it, market makers will be able to say, "Well, I'm not going to let you out unless unless you sell it at the full bid," right? And that's always a problem. So I'm looking for liquidity. So what I always tell new option traders, you're focusing on names like AMD and Apple, right? These names are very, very liquid. They trade lots of volume and options and stocks every day. You're looking at names like General Motors. You want to avoid names like Tesla to start because the bid ask can be very wide and they move very quickly. Amazon, right? These names can be very wild. Names like CMG, I don't trade period anymore. The option contracts are extremely illiquid, and the name is illiquid at this point because it's gotten so pricey. Only the big funds trade it. Very few people actually trade CMG anymore. It's mostly just the big funds.
Yeah, no, definitely. I mean, I think that's one of like the fascinating things about options is that one stock can be, great for trading options and one can be terrible, and it's hard for a new trader to kind of identify why that is or how to find the good ones.
Yeah, here's a little tip. If you're going to make an options bet and you can see however many options you're buying appear in the in the volume contract when you buy it, you shouldn't be buying it. Right? That's just a little tip from Mike, right? If you go to buy something, you're buying 10 contracts and you can actually see when you hit buy, the volume go up by 10, that means you're setting the market. You are the market at that point, and that's just a bad thing.
Right. And then, so do you have any preference as far as if a stock is, I mean, I know you said for kind of newer traders to stay away from Tesla, but if a stock is like a lot more volatile than a different stock?
Yeah, volatility we love as an option trader, right? Because volatility gives us range and range gives us more money, right? So we're always looking for names that move better. The thing you have to balance that out is with liquidity, and you want a tight bid ask. So what I typically tell traders is you don't want to pay more than 3 to 5% of the bid ask on the option. If you're paying more than that, it's probably spread pretty wide, and you're giving the market maker a lot of money to get you in and out of that trade, and could take away your profits or even give you a bigger loss if you have to get out. So that's something I always tell everybody. So for me, you're looking at the names that are good. So what you have to do is go through the different sectors and find names you like. So for me, I love JP Morgan and the banks. That trades very well. You go to energy, Chevron is another name I like, or Exxon Mobil or Oxy. These guys have volatility, they have range, they're liquid, they trade well. And it's always about having names in the sectors like AMD. I like Micron in the semi sector. Love NVIDIA. NVIDIA's actually now gotten much easier to trade after the split because, the bid ask is not so wide and it's trading a lot less. So it's not as expensive anymore. So we'll see how that trades. Names like Tesla, I love, but you have to know what you're doing. And you have to realize when you get in Tesla, that stock will swing $5 in a minute to 2 minutes. And if you're in options, you can get killed or just, blown out before you even realize what happens. So for a new trader, that's very, very difficult, right? It's hard to put in a stop and realize you're going to get stopped out very quickly if you're not careful.
Yeah, no, Tesla is always, it always seems like to me, maybe not so much recently, but like a year ago, like if Tesla opened down 2% and it was like, oh, okay, it's going to come back up here. If it opened up, it was going to come down. Like it seemed like it was never going to kind of stay in whatever trend it was in.
It does. That was one of the other interesting things today. Now, none of us traded Tesla short today. But if you look up here on the right side of the screen, I mean, this was as of like 2 o'clock. They were loading up on puts for next week on Tesla. You have at that time, there was 41,000 of the July 30th 500 puts and 39,000 of the July 30th 550 puts. And that, to me, that's, we know we have earnings on Monday, but that was some big buying coming in. And obviously, there's concern over Tesla here going into earnings next week.
Yeah, I mean, definitely going to be interesting. I mean, Tesla's so volatile without earnings. So when you do have earnings, it's always going to be a catalyst for either a big move up or a big move down. So, Mike, we do only have a couple minutes left. Let me pull some questions from the chat. Leah is asking, what about buying in the money? So do you prefer to kind of buy, right out of the money, or do you sometimes dabble with some plays in the money?
The only stocks I'll buy in the money are cheap stocks. So a name like GE, and again, it's about looking at how far they can move. GE moves like 30 cents a day. So the only way you're going to make money is by buying in the money options at the money or just inside the money, because it just doesn't move enough to make money on it. Again, look at the ATR is what I always tell you. If you look at how far a name can move, that tells you where you can play. trading a name like Tesla or Amazon at the money, you're going to pay a lot of money on that option. And again, an Amazon can drop $10 in a minute. If you have a 45 or 50 delta, and we can go over delta next week because we don't have time here, and it drops $10, your option probably just got cut in half in 5 minutes. And Amazon is capable of doing that in 5 minutes without a question. So typically, I prefer to go out of the money so I can, have more time to let the trade work for me.
100%. All right, Mike. Well, unless you got anything else you want to add, just real quick, Zinger Nation, we have Mike's Twitter in the description. It's @OptionsMike. We also have his website there, Smart Options Trading. So go check that out if you want some more content from Mike. Otherwise, we will be back on another episode of Options Trading with Options Mike next week. Mike, anything else you want to leave the audience with?
Don't forget to tune in on Saturday. We have the Benzinga teaching session. I'll be live on that at 11:30.
Yeah, the Benzinga Bootcamp. Thank you for reminding me. I'll throw the link in for the chat as well. You can go to benzinga.com/events, find the link for the bootcamp, get signed up for that, because we have a lot of different traders that are going to be giving some great insight, including Options Mike, talking more about options. Do you have a topic for Saturday in mind, or are you going to go?
Yeah, how to use options to accelerate your trading, better your trading. So we're going to go over some of the basics and then different ways you can use options and how they can help your trading throughout the day.
Beautiful. All right, Mike. Well, thank you for joining me tonight. We'll talk more about next week, see if we want to change anything up. Maybe we'll go for an hour next week to get some more questions out of the chat.
Sounds good. Thanks, everybody. Aaron, been a pleasure. See you next week.
See you, Mike.